Okay, let's go ahead and get started. Thank you all for joining us this morning. We have another webinar lined up for you today. We're going to be discussing current challenges and opportunities for PE firms and portfolio companies managing financial risk. Looking forward to getting to that discussion. Before we do, of course, we have a few housekeeping matters we'd like to get through. For those who don't know who I am, my name is Lena Dobrier. I'm the Director of Operations at Opus Connect. Excuse me. We are a lower middle and middle market M&A focused organization. We're membership based. We have chapters in Los Angeles, Chicago, and New York, where typically we would be having a roundtable or a panel once a month in each of those markets. Of course, it's all virtual now, as are our Deal Connects. Many of you are participating in our middle market Deal Connect today, where we're pairing up capital providers and investment bankers for one-on-one meetings. So that's a little bit about Opus Connect. If you want to learn more, who we are, how we can help, please reach out to my colleague, Jacob Zeffrin. His contact information is below. He'd be happy to answer any questions you might have. As we shift to the next slide here, our panel will be taking live Q&A today. So as questions come to mind, you'll see that little box at the bottom, rather bubble at the bottom of your screen labeled Q&A. Please do not use the chat function. Use the Q&A function. It'll be easier for us to monitor, and we'll try to get to as many as possible. These events, of course, would not be possible without the support of our sponsors. So I'd like to give each of them a moment to introduce themselves. And I don't believe Steve Finder of Focus Search is in the room today. I do believe you'll be hearing from him later. Executive search entity. They support private equity firms. If you want to learn a little bit more, please reach out to Steve Finder. His contact info is there. Let's shift to the next slide here. Of course, Plant Moran. If anyone is in the room from Plant Moran, go ahead and okay, John, I believe John, let me see here. John, are you with Plant Moran?
Yes, Lena. Hi, Lena.
Okay. Go ahead and introduce yourself and your firm, please.
No, thank you so much. So I'm John O'Connor, I'm a partner at Plant Moran. We are proud sponsors today of Opus Connect. Plant Moran serves over 1,500 private equity funds and portfolio companies. We're looking forward to our talks today. We help with everything from sourcing to structure, diligence, first 100 days, which is a key focus for us today, and then sale readiness. And our teams are comprised of smart people who provide excellent service. So we're looking forward to speaking today and appreciate the time. And thanks everybody for joining.
Thank you, John. Appreciate that. Let's move to the next slide here. NFP, longtime insurance sponsor and partner of Opus Connect, based in New York. Duncan, I see you in here. Go ahead and introduce yourself and your firm, please.
Great. Thank you. Thank you, Lena. And thank you, as you mentioned, to Opus for, the long-time partnership. As Lena mentioned, NFP is a global insurance broker, really focused on middle market clients. We have a team dedicated to everything, all the insurance needs of private equity firms, their transactions, M&A deals in general. So providing everything from due diligence to portfolio insurance aggregation, transactional insurance policies like rep and warranty, we've grown quite a bit over the past few years and built out our M&A team. And would love to chat with anyone who's interested. But enjoy the event, and thank you all for being here.
Thank you, Duncan. Next, of course, I want to acknowledge Vorys. Nici Workman, of course, is going to be moderating today, so we'll wait until we introduce her before we introduce the firm, but definitely want to give them a shout out. We'll shift to the next slide here. We have just 2 poll questions that we'd like to ask of you. We would encourage your participation. This will help us understand who's in the audience and who we're speaking to today. So I'll go ahead and launch the first one. If you could just submit your answer. We'll try to move through these 2 fairly quickly. We want to know which best describes you. Are you an independent sponsor, investment banker? I'm sure we'll have a good amount of investment bankers and capital providers given our Deal Connect to follow. But go ahead and submit your answers and we'll review them and move on. Don't be shy. I can see who's responded. Okay, we'll give it about another 10 seconds here and then we'll move on. Great. So 8% independent sponsors, 16% investment bankers, capital providers on both the debt and equity side, 24% and 16% respectively. And of course, our sponsors, 32%, and some others. Thank you for participating in that. I do have one more question that I'd like to ask, and this is around in-person events. When are you going to be comfortable attending them? Now, after January, not until we have a vaccine, which is now in some places, or never. You never liked them and you want to continue on virtual. Go ahead and let us know. We'll share it for another 10 seconds and then we'll begin the discussion. Okay. So 16% of you are good to go now. Awesome. 16% also possibly after January, which a month. Okay. Majority 56% not until there's a vaccine. Understood. And 12% never liked them anyway. So you prefer the virtual. Awesome. That's really interesting to know. Thank you all for participating. And without further ado, let's shift to the next slide. I'd like to introduce today's moderator, Nici Workman of Vorys. Nici, the floor is yours.
Thank you, Lena, and thank you, everyone. Thanks for having us. As Lena mentioned, I am a partner at Vorys, Sater, Seymour & Pease, and Vorys is an AmLaw 200 firm based in Columbus. We have offices across the country, and our newest office in Southern California will open at the start of next year. So we are officially coast to coast. And excited to be with you today. I co-chair our finance practice at the firm, and my practice centers on large financial transactions. We represent lenders and borrowers. I always say not at the same time, but in different transactions on large credit facilities. And we also do a lot of work in the derivative space, including with our colleagues here on the phone or in the webinar today from Fifth Third. We represent large regional banks in the derivatives programs with their customers. We also represent a number of large public companies in respect of their derivatives and their hedging programs. So really excited to be with you here today and look forward to the discussion. Very timely one, as we'll talk about here shortly. I'd like to introduce our three panelists. So first we have Mike Orefice. Mike, do you want to say hi?
Hello there.
All right, and you can.
Thank you.
Yeah, go ahead.
Sure. Thank you all for attending today. I'll just give you a brief rundown, which I'm sure will come up. Yeah, as they call me here at Fifth Third, I'm a 3-tread. This is my third go round and final at Fifth Third. Prior to rejoining in 2017, I spent 17 years overseas with Standard Chartered and most recently with Macquarie Bank in London, where my role was specifically dealing with sponsors, hedge funds in this particular space. Have helped try to bring that expertise over to Fifth Third, where we've historically been a portco focused business in FX and commodities, but we've expanded that in the last 3 years to actually do business directly with the sponsor. So look forward to getting some questions and hearing about your businesses. And thank you again for attending.
Thanks, Mike. Tom, do you want to introduce yourself? Tom,
we're unable to hear you again.
Still had the mute on. All right. So yeah, thank you. Okay. Yeah. Again, thanks everyone for attending as well. Yeah. So I'm actually a CPA by trade originally, though I've been in the banking space for about 20 years. And again, working obviously a lot with the sponsors and their portfolio companies as they look at different hedging programs with the bank. So I've been doing this almost 20 years with the bank and still keep my CPA license, but obviously heavy focus on interest rate risk management for companies and their owners.
Thanks, Tom. And our third panelist, also from Fifth Third, Stefan.
Thanks, Nici, and thank you everybody for joining. My name's Stefan Hayek. I'm internal counsel here at Fifth Third, supporting our commercial lending platforms as well as our capital markets folks, including Mike and Tom, who are also on the line, and also supporting the bank in regulatory initiatives.
Fantastic. All right, so a couple brief disclaimers before we get started. You are joined again by folks from Vorys and from Fifth Third. As typical with these sorts of programs, the views expressed here are our own and not a representation of our institutions. And also for the lawyers on the panel, this should not be construed as legal advice. We're sharing with you our thoughts, but recommend you follow up any questions with your counsel. And also, we will not be addressing any tax or accounting issues. So oftentimes when we're talking about derivatives and hedging, of course, tax and accounting are all very relevant. We will be shying away from those topics today, but certainly encourage you to discuss any tax or accounting questions with your tax and accounting advisors as well. So with all of that out of the way, we can jump into the discussion. And I'm going to start with really just a level set. So for those of us who do this for a living, we use words like hedging and derivative and swap often interchangeably. I'll start with Mike and Tom for you. When you hear these words, hedging, derivative, swap, are these really synonyms for the same thing, or are there differences in the way that we use them?
Yeah, I'll go ahead and jump in there. Well, they can mean the same thing, certainly, and it just kind of depends on the context in which you're speaking of them. Obviously, from our perspective, we take most of our trading activity with customers is virtually all hedging, right? We really don't do any speculative trading at the bank, though obviously some things can have a look or feel of that, right? Portfolio hedging and things like that could be a little more complicated in terms of those structures, but really we focus on hedging programs, not speculation type trades. And I suspect that's probably true of almost everybody that's attending this webinar. And so when you get into things like swaps, for us, that's a pretty specific term in terms of an interest rate swap that goes out for a period of time. Mike can speak a little bit on the other side. But and Stefan can talk on the regulatory side. I think when the regulators use the term swap, they're kind of putting everything in the same bucket, right? Any type of derivative type trading activity. So it really depends on the context that you're in. But for us, a swap is a pretty specific term. So when we're talking about borrowers, we're looking at, a swap, a cap, a collar, and transactions like that.
Mm-hmm, mm-hmm. Yeah, Stefan, do you want to weigh in from a regulatory perspective? Swap does have a very specific meaning.
Yeah, so in the regulatory environment, swaps do have a very specific meaning and relate to very specific products, including, in the interest rate space, you're talking about interest rate actual swaps. Certain products fall outside the definition of a swap and therefore are subject to a different set of regulatory obligations. The primary regulator in this space is the Commodities Futures Trading Commission. And if executing within certain asset classes, in particular swaps in certain asset classes that kind of extend beyond what would be considered to be more cash products, spot FX and certain products like that, they're subject to a very specific set of regulatory obligations. And oftentimes you'll find yourself executing those sort of transactions with registered swap dealers. And those are entities that are registered with the CFTC and subject to a very, very rigorous set of regulatory obligations and expectations.
Mm-hmm. Yep. And then Mike, Tom mentioned the difference between hedging and speculative trades. Is there an easy example of what might be a speculative trade versus a hedging position?
Sure. I think the easy look, and I will tell you, after starting my career at Fifth Third in '88, which dates me a little bit, I've dealt with all kinds of clients. The hedge fund community back in the '90s, where it was all speculative. I think the biggest difference now, and really where we play, has been in the hedging space, where there's an actual underlying exposure. Whether you're purchasing a piece of equipment from Germany, or you've got a cash flow, or you've borrowed 25 million Canadian dollars from your Canadian sub. Speculation is where there's not an underlying asset class, and the FX product or the commodity product or even the interest rate product that you're trading is the asset itself. So that's probably the easiest way to do it. Again, we frankly, I've been back 3.5 years, and we don't play in the speculative space.
Mm-hmm. So I think that's a great distinction. So think about, from a hedging perspective, there's an actual underlying risk that you're hedging. And then in the speculative category, I guess the way I think about it is more like an investment. You're taking a position on where you think the market's going to move, but you're not actually hedging an underlying risk of the business, whether it be interest rate risk, foreign currency risk, or otherwise. So, okay, perfect. So with that groundwork, let's move forward into some specific types of strategies. So Tom, let's start with you. What are some common strategies for companies in managing interest rate risk?
Yeah, I think, well, we'll circle right back to the term swap, right? So I would say probably 90% of the trading activity that we do with our customers tend to be interest rate swaps, right? So basically taking their exposure on their debt that they have, that's either, Libor, primarily Libor based, and then looking to fix in that cost of Libor for an extended period of time. So typically could be as short as 2 years for our types of trades. We'll go out as far as 10 years for limited exceptions. The lion's share of our trades are probably in the 3 to 5, 7 year range. So basically borrowers that are financing long-term assets, and they want their liability position to look very similar. So they'll look to lock in their cost of their debt financing that underlying asset for a similar time frame. So 5, 7 years, for example, would be pretty common. So that is the most typical way that we hedge. I will say that, again, when your investment time frame as a business owner is shorter than that, right? So I'm looking to buy a company and hold it for a few years. Typically, they're not looking for 5, 7 year swaps, so they'll look to take some of that risk off the table and do something a little shorter, like an interest rate cap that provides some level of insurance, but really doesn't necessarily lock it in. So it provides a maximum interest rate that would be felt on their Libor exposure. So those tend to be shorter in duration. They're a little more efficient in that space. So 2, 3 years is kind of that is a typical trade in there. So those are the most common things we've seen, and traditionally. Having said that, obviously we'll get into the topic a little bit later, but with things moving on the Libor front, we have seen a fair amount of activity here more recently in prime. So it's not a pervasive trade that we're seeing, but with companies looking to eliminate the transition issues associated with Libor down the road, we have seen a pickup in prime that, I can tell you, 2 years ago, we probably had maybe one trade on the books that was using prime as an index. In the current environment, I'd say probably 10% of the trades we did this year were probably prime based, just again to try and avoid any future exposure there. So as long as your lender is comfortable lending to you on a prime basis, we can do an interest rate swap that would mitigate that risk associated with prime volatility as well. So that is one of the more popular things we've seen in terms of a shift in the product mix. And then the other thing I would say that has become more popular here, especially since the market kind of tanked off the pandemic news earlier this year in February, March timeframe, and the Fed aggressively cut rates basically back to the zero bound. With that, long-term interest rates plummeted, and I think a lot of borrowers decided that was a good time to take advantage of that very low, flat yield curve and fix in for or hedge their interest rate risk for longer than they probably might have in a more normal interest rate environment. So we're seeing a lot of appetite for longer durations on trades than what we typically would see. Just because, again, when the nominal yield is under 1%, it's for, 5, 7, 10 years, that just has a fair amount of attraction to it. And so we've had a lot of those opportunities this year.
Mm-hmm. Tom, you talked a little bit about the difference between an interest rate swap and a cap. What about cash outlay? So if a company is entering into an interest rate swap, is there an initial cash outlay? And then same question on the cap side. So distinguish the two in terms of initial cash outlay for the products.
Yeah, sure, that's great. Obviously one of the things that is attractive about the swap is that you are literally just agreeing typically on almost every trade we do, where you're just agreeing to swap out payments, right? You pay me fixed, I'll pay you float, and the initial outlay is usually zero for that transaction. And so there's no initial cash outlay. You're basically just agreeing to pay a fixed rate down the road. Now, obviously, it is a very flat curve, but fixed rates are higher than the short-term floating index rates like Libor. So there is an initial cash cost on a monthly basis on those trades. And then, obviously that could flip if Libor rises. But that is a very attractive feature, that there's no initial outlay. And obviously with a cap, the downside to that typically is that you do, it's a little bit like writing an insurance policy. You got to pay the premium up front, and you collect on that insurance policy if the index rate exceeds for continuing the analogy, if it exceeds your deductible, right? So the strike rate that you set, right? So if you bought a cap on Libor at 1%, you wouldn't receive any payments from your provider until Libor actually exceeded that strike rate of 1%. And to buy that policy, you've got to pay that premium up front. There are versions of that where you can do a financed cap premium. It's not very common, and with the rates nominally so low, the insurance policies are relatively inexpensive, so we don't get a lot of requests to finance those because the cost of the premiums, frankly, really just are not that high in the current environment, all things being equal. So it's a pretty good, cheap insurance policy, especially when you keep it to a shorter duration, which is where that kind of option pricing is probably the most favorable.
Mm-hmm. Yeah, that's helpful. Thank you. I want to go to Mike next. I know Mike's having some issue with his video, so we'll see if the audio is working. If not, we can move on to a few other questions. Mike, are you there just to check?
Yes, I am. Sorry about that. I think it's probably saving me, but you can hear me. So
yeah, perfect. All right. So Mike, similar with the general interest rate hedging question for Tom, what are some typical ways that companies and PE firms use FX products to manage currency risk? You mentioned in your initial remarks examples of, buying a piece of equipment in Germany or hedging other sorts of things. Can you give a few examples of how FX hedging products help to protect risk in those sorts of scenarios?
Sure. I think there's a couple things, and it really depends upon the PE firm and how they choose to run it. So I'll run through a couple of scenarios that I've seen that are most popular. One is, and it's certainly at the portfolio company level, where the sponsor, the private equity firm, allows that portfolio company to basically act on their own. Once they've made their initial, whether it be a loan or their initial capital injection, the treasurer, the CFO are allowed to basically run their business as they see fit. They introduce a group of banks. We all talk to them about different ways to hedge, and they hedge their day-to-day operations. Where I think we've seen things change over the years is, and it depends upon, and if I name some of the names, I suspect everyone on this call would know who they are. You've got some private equity firms that will do top-down. And sponsors, they will manage, say, 7 portfolio companies, and they will aggregate the foreign exchange where they can, and they will manage it at the CFO type level. The other one, which I think is most important and where the transactions are by far the largest And from a tenor perspective, as Tom said, you can go out 5-7 years, are the initial investments on some of these larger transactions. For example, we've seen large utility companies being purchased. We've seen significant initial investments in anything from real estate to sports teams, where the financial sponsor anticipates an exit. So, we've seen everything from a spot transaction, where they will actually purchase the currency, to buy the asset. And then what we will do is we'll do an analysis on what they believe is the exit. So whether that's 3-year horizon or 5 or 7 year horizon, and they will use anything from regular forward contracts or swap contracts, as you mentioned earlier, to option contracts, which are very popular given the uncertainty around the duration. But I also think what we have seen too is trying to hedge the cash flows. So for example, I was part of a transaction where we purchased a building in Singapore, and the client was the landlord. So they put in an initial 30% down payment, which we converted from dollars to Singapore, put that in. And then what they did was they hedged 40% of cash flows, so rents coming in over a 5-year period. Then we looked at a transaction, sort of a bullet option, to exit that actual asset. So it's really a combination where we found and again, it's not a sales pitch for Fifth Third, we find when there's a collaborative approach between a sponsor and their portfolio company, where the portfolio company is allowed to run autonomously, and because they know their business is best and they manage it. Because what we tend to do is, as you know, in our market, certainly where things are moving rapidly, we like to be able to get to the decision maker right away. So there's a less need for collaboration and checking on prices. So if we see an opportunity in the market that meets the client's hedging needs, we want to be sure they can take advantage of that. So I would say of all of the things I've seen right now, which I think is happening more and more, as you've seen a lot of these sponsors, private equity, move into, say, smaller middle market, the middle market clients are allowed to be more autonomous and deal directly with their finance providers.
Yep. Mike, you mentioned options a couple of times. This is the first time that's come up. Can you describe a little bit how a typical option would be structured and how it might work?
Sure. It is the right but not the obligation. I'm sure folks have heard that term before. So, for example, going back to buying the piece of equipment, probably not a great example because you're definitely going to buy it. But if you believe over the course of the time you need to pay for that, given the current environment where you've got some political unrest, you've got a global pandemic, you might think that there's a potential that the underlying currency will move significantly enough that you're willing to pay a premium. So what that allows you to do is, with a forward, if you enter into that as a hedge, whether the underlying equipment goes away, you are obligated to own that contract. So you have a liability there. With an option, you pay a premium up front, and anytime during the life of that contract, you can sell that back, or you can wait till expiration, depending upon whether or not the underlying asset's there. But obviously, in this particular case, you don't get that optionality for free. You do pay a premium up front. Mm-hmm. That'd be the biggest difference.
Yep. Thanks, Mike. All right, let's pivot a little bit and talk about Libor. Tom mentioned this earlier. And for those of you following the topic, you'll know that there was a big announcement on this front in the US on Monday. So we'll talk a little bit about that. Stefan, we'll turn to you. So there's been a lot of talk about Libor going away by the end of 2021. The announcement on Monday kicked that out to some extent relative to US dollar Libor until the summer of 2023. What exactly is happening, and what does it mean for Libor to no longer be available?
Yeah, sure. So first we'll start with just the basic concept of, when we're talking about Libor, what are we really talking about, and what's going to go away in the first place? And Libor, it stands for the London Interbank Offered Rate, and it's really the most prevalent benchmark that's used for short-term rates. And as I would assume most of you know, it plays a really critical role in our global financial markets, and it's responsible for backs, or as the reference rate, I should say, for trillions of dollars in contracts across the spectrum, right? Whether it's corporations, banks, broker-dealers, investors, consumers, et cetera. We can talk a little bit. Nici, does it make sense to talk a little bit about how LIBOR is calculated, or do we want to focus on how it's going to go away?
Well, I guess the two I think are related. Talk very briefly about how it's calculated. I think that then helps to understand what it means to go away.
Yeah, sure. And look, I think a little bit of history is helpful to understand why it is going away in the first place. So just for a little bit of background, on what LIBOR is intended to represent and how it's calculated, it's really intended to represent the interest rates at which major banks would borrow from each other. And it's produced in several different currencies. I believe it's 5 different currencies. And it's also produced at various tenors. And the way ICE Benchmark Administration is the administrator for LIBOR, and they receive quotes every day from these submitting major global banks. They remove the highest and the lowest submission, and they basically take the average at each tenor, and they publish that once a day. And that's the LIBOR rate that we see. While it is a really prevalent benchmark, hundreds of trillions of dollars in transactions a year, LIBOR actually isn't really based on a very active market anymore, the interbank borrowing market. Actual interbank volume has declined significantly over the years. And because of that, LIBOR published rates are based on both actual data points, limited data points, those are transactions, and to some degree on the professional and expert judgment of the submitting banks. So those two factors combined, the declining volume of interbank lending and this professional judgment, which in part may have contributed to some of the LIBOR manipulation scandals that we saw come out, most notably in 2008 with the rigging scandal. I think it's caused regulators and market participants across the globe to question the long-term sustainability of LIBOR. So that's sort of the background upon which in 2014, the Board of Governors of the Federal Reserve and the New York Fed, acting on recommendations from the Financial Stability Board and FSOC, signaled their intent to transition away from LIBOR-based benchmarks. And in doing so, they convened this group of market participants called the Alternative Reference Rate Committee, or the ARC. And the purpose of the ARC is really to lead this transition away from LIBOR and find a suitable and very robust reference rate that wasn't susceptible to the same sort of perceived shortcomings of its LIBOR predecessor. The timeline, I think, as Nici just mentioned, the timeline for LIBOR cessation has really been a moving target since really 2014. The industry has been really diligently working towards a transition away from LIBOR, and up until I believe it was Monday, Nici? I think it was Monday.
It was
November
Monday morning.
30th. Yeah, Monday morning. Everybody was targeting the end of 2021, but as Nici had mentioned, even just a few days ago, the Federal Reserve, the OCC, and the FDIC announced that the LIBOR administrator, ICE Benchmark Administration, is considering expanding the publication of LIBOR through June of 2023.
Yes.
So that kind of brings us to the big question, which is what happens when LIBOR goes away? And the simple answer to that is that it's going to need to be replaced with an alternative reference rate. And the ARC, as well as a number of other industry initiatives and regulator initiatives across the globe, are working both collaboratively with the marketplace and collaboratively amongst each other to design a sustainable alternative reference rate. These aren't small tasks, because to accomplish the objectives as articulated by the ARC, primarily in the United States, they really want this successor rate to be objective and based on a market that is robust. They want it obviously will need to comply with international benchmark standards, including the IOSCO standards. They're going to need to have, and the marketplace is going to need to have, a strong plan in place to incentivize acceptance and uptake of this new successor rate. You don't really want significant divergent practices. And the industry is going to need to develop, establish, and put into place best practices to ensure that all the work that needs to be done to ensure that contracts that are currently tied to Libor can accommodate both that Libor cessation and the implementation in an efficient manner of new benchmarks. And the industry is fairly along in that process, but I think we're going to have a little bit more to come on that in a minute.
Yeah, no, thank you, Stefan. That was a great intro. And I mean, there's a lot to unpack there. And this is not the panel that's doing a deep dive into this. I mean, we could spend honestly an entire day or longer talking about these issues and how exactly Libor is calculated. The stated replace or the preferred replacement rate by at least the ARC is SOFR, and we could spend a day talking about what the heck SOFR is and how it's calculated. So the goal of this panel is to keep it high level and explain these issues are coming down the pike and what you should be thinking about now. And I think it's worth pausing here to unpack a little bit of what Stefan was talking about from the perspective of a portfolio company and private equity sponsor. Two primary buckets of obligations we think about being affected by Libor. There are likely more, but credit facility borrowings, vast majority of which are based on Libor, and any interest rate hedges tied to that. So keep that in mind as you think about these issues, and also too how the two relate to one another. Stefan, we'll come back to you for another question on the industry initiatives front that get at this issue. You mentioned ARC, the Alternative Reference Rate Committee, and they've been working for a number of years. We also have ISDA, which is the primary trade organization supporting the derivatives market. They've also been working on their own initiative to deal with Libor and what happens when it goes away. Again, we could spend 3 hours talking about this issue alone. At a high level, what's ARC doing in the cash market? What's ISDA doing in the derivatives market, and how are they different?
Yeah, sure. So we can start with the ARC, and really since the formation in 2014, the ARC's sole focus has really been to identify the successor rate. And in 2017, as Nici had mentioned, they identified SOFR, which is the secured overnight financing rate, as the proposed successor to Libor. It's definitely worth mentioning that this is with respect to US dollar Libor. There are parallel initiatives going on across the globe related to the other IBORs. But a little bit about SOFR and kind of why they decided on SOFR, maybe a couple of differences between SOFR and Libor. And then we can talk a little bit about what ISDA's doing too. And I think it's also important to hit why the ARC, or what the ARC, sort of the plan that the ARC has to roll out SOFR. So first, a little bit about SOFR itself. It's an objective rate that's based on a very liquid overnight repo market, which significantly mitigates two of the primary concerns that existed with respect to Libor. One, liquidity, and two, the concerns around manipulation, because it is based on a very robust market. Some really important differences between SOFR and Libor. SOFR is a secured rate, and it doesn't incorporate a credit risk premium, unlike Libor, which is an unsecured rate. SOFR is a backwards-looking rate, and Libor is a forward-looking rate. And currently, there's no term structure available for SOFR benchmarks. We do believe that those will develop as a robust futures market continues to develop. But Libor is and currently has multiple term structures and has a term structure and is published at various tenors. So SOFR, they started publishing SOFR in about 2000, I think it was 2018. And there's really been a slowly growing market for both trading and clearing of SOFR futures as the industry moves along with the transition. And to facilitate this transition, the ARC has produced recommended best practices and identified key, I guess we call them milestones, key milestones in the transition process for market participants, end user, and banks. And these publications that they're producing, and all of which are available on the ARC's website, they provide timelines for adoption of Libor fallback language into existing contracts. and really talk about what the best practices are to facilitate that smooth transition. As it relates to specifically the fallback language, the ARC has a series of recommendations related to fallback language. And when we talk about fallback language, what we're talking about are existing contracts that are Libor based and that do not currently incorporate a fallback in the event that Libor ceases to be published. Some contracts may contain some very limited fallbacks to, to benchmarks like in the event that Libor becomes temporarily unavailable. But really what the ARC is doing is they're trying to facilitate the uptake of that replacement rate SOFR by creating a standardized mechanic within contracts that can be inserted into contracts to ensure that that upon the cessation of Libor, there is a consistent industry adoption of uniform rates. And so those recommendations are published on the ARC's website, and I definitely encourage those of you with interest, if you haven't already, to dig in a little bit. I think the two most relevant publications of fallback language would probably be the ARC recommendations for bilateral business loans and also the syndicated loan recommendations. And Nici, does it make a, go ahead.
So then just on the ISDA
Yep.
front, so ARC has their set of publications for the loan side. What's ISDA doing on the derivative side?
Yes. Yeah, so ISDA has adopted a fallback supplement and a fallback protocol that really amends the ISDA definitions to incorporate these mechanics for Libor's transition. These changes to ISDA's definitions will take effect in, I believe, they will take effect in January. And I mentioned this concept of a protocol. If you're not familiar, many of you I'm sure are, ISDA, as they oft do, has designed a process for legacy uncleared derivatives that effectively allow parties to adhere to certain terms through ISDA's website that is currently open. That protocol is open, and it allows them to incorporate these fallbacks into existing transactions. And that would be transactions that were executed prior to October, late October of this year. And to sum it up, ISDA's approach largely aligns with the ARC's hardwired convention. ARC has multiple conventions. One is an amendment approach that provides for certain flexibility and effectively does not mandate the waterfall that will exist with respect to benchmark replacement selection when Libor ceases to exist. And then they've also published this hardwired concept, which allows predefines set triggers upon Libor cessation, and then identifies set reference rates, a term structure, then a simple SOFR structure that would be adopted upon the cessation, and that would be adopted upon the cessation of Libor. And ISDA's protocol approach largely aligns with that, with that approach, with a few small differences in that waterfall.
Mm-hmm. And thinking about all this, Stefan, and tying it back to our theme for this program and managing financial risk. This is the lawyer speaking, not the derivatives professional, but my understanding is derivatives hedging in particular are used to manage risk and help control uncertainty. And it sounds like all there is uncertainty in the interest rate world right now. So Tom, let's take it back to you and tying this back together with hedging generally. So as we move towards the end of Libor cessation, what should companies expect to see happening to both their existing Libor-based swap portfolio and their ability to execute new interest rate swaps tied to floating rate debt? So if Libor is around for another bit and they're still borrowing at Libor, will companies still be able to manage that Libor floating rate risk? And at what point will that become difficult? And what would that, of course, this is a crystal ball kind of question because there's still a lot of uncertainty. You're on mute, Tom.
I keep muting to make sure I'm not.
That's what you're supposed to do.
Yeah, sorry about that. So yeah, I think there's still a robust amount of trading activity in Libor, right? Frankly, to the dismay of some of the regulators that would like to see that volume shift over to support the new index rate of SOFR. But nonetheless, Libor is still the prevalent index for lending, and therefore, from a derivatives perspective, that's going to still be our primary vehicle. So there's still lots of liquidity out there, and a fair amount of, until SOFR becomes a more prevalent index rate in lending, which should happen, start happening in early 2021, and that's really what we're working for at Fifth Third Bank, and obviously most of the financial institutions are kind of on that track to move in that way. So to eventually displace Libor with SOFR as your primary index cash rate in our credit agreements. Once that starts happening, then obviously the derivatives market volume will pick up in conjunction with that. So it's kind of a chicken and the egg thing, right? One is not overriding the other, and it's very difficult to get one to go without the other. So we're going to really have to just kind of keep going down the path. I think most borrowers, like I said, understand the issue of transition and the fact that if I do a Libor trade today, that there's a high degree of likelihood that by the end of that contract, depending on its duration, it's going to be transitioned to SOFR through some type of mechanism, either through a fallback provisions that now exist in the agreements, or through future amendments in their credit agreements. But that's just the nature of the beast, and everybody's kind of got the same issue, so we're kind of all in this together, if you will. For those that just, like I said, couldn't get over that hump of, I hear what you're saying, I understand, but I'm still just concerned that it's not going to all come together the way it's supposed to. So what else do you got? And so that's when we kind of pull the prime index out. And that works pretty well in the bilateral space. It's a little more difficult if you're in a syndicated credit facility with multi-banks to get everybody to agree that let's use prime as an index rate. There's a reason the market moved away from prime years ago as a primary vehicle. It's, for all intents and purposes, though it's a Fifth Third can set their own prime wherever we want. Most of the banks, if not all the banks, pretty much just stay in lockstep at 300 over the Fed funds target rate. So prime is largely just a government mandated rate, for lack of a better description. And therefore, we want to use index rates that are tied more to market conditions for our lending and therefore our trading activities associated with that. So you can't stop managing your risk just because we have this issue going on, right? And so the activity is still taking place. We're just doing it with open eyes that we're going to have to deal with this issue at some point. And the faster we can make the transition to a new index rate, I think the easier this will be. So, we're, despite the recent announcement about the delay of the potential cessation of Libor to 2023, I don't think that really changes the path for new lending and new hedging. Right. This is really about just giving time for those legacy contracts to transition on their own merit. The vanilla swaps and things like that are pretty easy to understand what will happen. But, not everything is simple in the lending and the derivative world, right? So trying to negotiate bilateral agreements on all those contracts out there where there are bespoke terms and conditions can be just overwhelming. So I think this is a good middle of the road approach to give more time for the legacy contracts to run their course or to negotiate those provisions, and then, start in full earnest in 2021 with SOFR-based lending and hedging.
Yeah, that's helpful, Tom. Thank you. Mike, and I have another question I want to get to before we close, but the answer to this may be no, but all this talk about Libor and uncertainty in the interest rate world, from my understanding that there are some FX products that have an interest rate component. Are you seeing any impact of the uncertainty around interest rates manifest in the FX market, or are they operating pretty autonomously in respect to this issue at least?
No, absolutely. Great question. I think the answer, without sounding too flippant, is no. I think the one concern that I would say the markets have in general would be the pushing out to 2023. Obviously, the interest rate derivative is going to be managed in your whole risk portfolio. I think what FX markets get concerned about, and it's not so much as the underlying interest rate, is if it blows up. If there is a point where banks are stressed because they've kicked that can forward. But from a day-to-day perspective, both in FX and commodities, frankly, there's been very little that has affected the underlying FX markets with regards to the SOFR transition.
Yep, that's helpful to know. And then Mike, let's stay with you. The last question, then if we have any questions from the audience, we're happy to take them. Bringing it back to the issue du jour, well, I guess there are two issues du jour. We've been talking about one of them as it relates to Libor, but COVID and the impact COVID has had. Have you seen any impact, first for you, Mike, on the FX hedging market, and then Tom, for you, what impact, if any, has COVID had on the interest rate hedging market? Mike?
Sure, absolutely. It's kind of almost been two-tiered. It's been we've seen such swings in FX commodities in the commodity markets where we've had companies come in and hedge out for the next 2 years, which is great for us, but obviously for next year and trying to generate revenue, it may slow us down. But I think what's happened is the underlying assets have moved so much, the euro specifically, the sterling, obviously with what's going on in the oil market, we've seen the uncertainty cause more hedging activity. We've also seen where clients have backed off hedging, where the market has moved in their favor so much, they've leaned towards options more so than we have in the 3 years I've been here, because they do want to take advantage of being hedged, but potentially participating in some upside. So I think it's twofold because of the uncertainty, and that, COVID was led into from, the steel tariffs, the political uncertainty, and a few other things where the uncertainty out there caused people who might normally hedge, say, 50% into year 2 are now 75% and or hedging 25%. So they're still absolutely hedging, but what has changed is both the temp, and we've seen our credit folks be very, very, not useful, that's not a bad word, very, very helpful with our businesses and our clients to understand the growing need to be flexible in what moving things into this year or pushing things out even as far as 2024, depending upon anticipated volumes. I'd say that's the biggest.
Yeah. Sounds like industry and specific customer even down, it's really just a matter of their individual circumstances, whether they're going to 75% uptick, as you mentioned, or down, reducing their hedging.
Absolutely. And I will tell you, you can pick without too much thought, you can pick some of these industries. We've dealt with several logistics companies that they're trading more, they're doing more hedging with 1 year than they've done in the previous 5, because they've seen their volume of business go up 300 to 400%. The downside, however, is that the use of forwards for hedges, where we've clients who were hedged prior to COVID, but they're seeing order cancellations. And so the flip side of that and the downside is that we're helping them blend and extend those trades, and or in sometimes, frankly, exit those at arguably not too great rates. But we're doing our best within what we can to help that. So that's the agony and the ecstasy of what's going on with COVID.
Mm-hmm. Yeah. What about on the interest rate side, Tom?
Yeah, I think that things are going to be pretty similar, right? We haven't really seen a shift in terms of the way we operate, other than, to the extent that the market has moved, significantly in the favor of someone that is currently borrowing, right? So funding costs for your financing activities have come dramatically down, right? So that has obviously had an impact on companies and the way they're investing their capital, and then turn that around in terms of that lending activity and therefore the hedging activity. So we've seen a pretty nice pickup for those companies that are able to do well in this type of environment. Now, obviously, we've got some sectors that are having a little tougher time in this environment, so that those sectors are down, right? The hospitality, the restaurant, those are a little bit slower. But that's been taken up by some people. There's winners and losers in this space, and so we're just seeing a fair amount of activity. The fact that everybody had to clear out of the building because of COVID, for a while there, that surprisingly really had no impact on the business virtually at all. Luckily, we've made the right technology investments over the years to enable us to basically just kind of do everything that we used to do sitting in an office downtown to being able to do the same things remotely. So that piece of it has been surprisingly easy. I would not have expected how easy that transition was going to be for us. And I think a lot of companies have experienced some things being easy, but other things being difficult. But we, at the bank, it's been great. And that's actually one of the other nice things especially on the FX front, right? The fact that we've got these, super nice platform, our market trade platform that enables borrowers to do these things remotely from their PC, as opposed to the old, trading days when people are yelling on the hoots across trading desks to get trades executed, right? Everything's much more technology driven. So really no impact there. It's really just customer specific in terms of what they're seeing and experiencing and what their needs are.
Yeah. Well, we're getting close to time. I'll pause. I don't see any questions come through the Q&A box, but Lena, I don't know if folks are able to raise their hand, but we'll give, an opportunity for anyone to ask a question just here for a moment. Anything from the audience that we can answer?
Yeah, if anyone has a question, feel free to submit it in the Q&A bubble below.
Okay. Well, we'll watch that for just a moment. I want to take this opportunity again to thank Opus Connect for allowing Vorys to moderate and co-host and present the panel. And I also want to thank our friends, Tom, Stefan, and Mike at Fifth Third. They are wonderful colleagues and very graciously agreed to bring their market knowledge and wisdom to you all today. And so thank you very much. I know it's a busy time of year for everybody. Thanks for spending the last hour with us. And of course, if there are follow-up questions, Lena, I think we'd all be happy to chat offline as well.
Awesome. Yes, thank you, Nici, and thank you to our panelists for your contributions. Definitely an insightful discussion. We will be posting this video to our YouTube in the next day or so, so keep an eye out on that. Of course, thank you to our sponsors and to all of you in the audience for attending. As Nici said, we know this is a busy time, so we appreciate your attention for the last hour. If you are going to be participating in our one-on-one meetings, you're going to want to sign out of this event, this link now, and log into the separate link that my colleague Terrence Winters circulated yesterday. We look forward to seeing you all soon, whether it be virtually or in person. And again, thank you to our panelists and for everyone participating. Take care, and we'll see everyone soon.
Thank you. Bye-bye.
Thank you.